Hello everyone, and let's talk about the weekly news. And it was eventful, from the long-awaited approval of the Clarity Act to the collapse of Bitcoin under pressure from inflation and bond yields. And the beginning of the week was promising. Bitcoin started at around $82,000 and the market was waiting for a breakthrough, but something went wrong. And by the end of the week, the price dropped below 78,000, and on Monday morning of the week, Bitcoin sank below 77,000. And what happened here? Why did the positive energy from the Clarity Act not deter the market? And most importantly, what can we expect this week? In general, we have a lot to discuss. Please like, subscribe, and let's get started. And so Bitcoin started the week on May 11th at around $82,000, and the market was moving in a range of 81 to 82,000, and traders were waiting for an upward breakout to $85,000. But Wednesday was the turning point. US inflation data turned out to be worse than expected, 3.8% against the forecast of 3.7%. And Bitcoin instantly fell to $79,879 and then rebounded to $81,208. At the time of writing this video, the asset was trading near $78,500, but on the morning of May 18th, it fell even lower. And what was the reason for such sharp reversal? Let's figure it out together. The key event of the week in macroeconomics is the release of the US inflation data. And the figures, they came out on May 12th and they scared the market. Annual inflation is 3.8% and core inflation, excluding food and energy, is 2.8%. And this is above forecast, and it's basically a pain in the booty hole for crypto. And why has inflation increased, you may ask? Reasons are expensive oil and geopolitics. The conflict in Iran continues to put pressure on energy resources, and the price of Brent crude oil rose from $99 to $106 per barrel in a week. Gasoline prices, a key component of a consumer's basket, also have jumped, and this was reflected in the numbers. Analysts warned us about it, that a hot CPI could trigger a massive exit from risky assets, and it actually did happen. But you know what? Inflation itself is just half the problem. The main problem is what the Fed doing with it. Before the release of the inflation data, the market estimated a 97.6% chance that the Fed would keep the rate in June. And now these expectations have only strengthened, but there also is a fear that the rate would remain high not only in June but also until the end of the year. And the market has started to lay higher for longer, and money will be scarce and expensive. So what happens in this situation? Capital begins to flow from risky assets to risk-free ones. And here we come to the most painful thing, the yield of the US Treasury bonds. On May 15th, 10-year US bonds broke through 4.55% level for the first time since May of 2025. Profitability growth continues, and this means that the investors can receive guaranteed returns from the government without risking anything. And why would they need Bitcoin then? The situation is worsened by the fact that the problems in the bond market are global just in nature. The yield on 10-year Japanese government bonds rose to the highest level in 20 years. And in the Eurozone, the same indicator reached 3.18%, a 15-year high. Analysts are calling this a bond market crisis. But there is a downside to this coin. Falling bond prices mean that money is leaving the sector. Question, where will they go? Some of them may come to the cryptocurrencies as an alternative asset class, and this is a medium-term positive for Bitcoin. However, in the short term, the pressure still remains. And now we add oil to the fire, literally and figuratively. The US-China trade talks last week did not please the market. President Trump traveled to China for a summit with Xi Jinping, and he was accompanied by the heads of Tesla, Apple, and Nvidia. The high status of the delegation was encouraging, but the result was just disappointing. No specific agreements on tariffs have been reached, and the only thing they agreed on was to accelerate the export of American agricultural products to China in the next 3 years. The trade war is not over. The uncertainty remains here. At the same time, the situation in the Middle East continues to escalate. Trump called the ceasefire talks in Iran unlit the board, and the conflict continues unabated. Of particular concern are reports of possible disruption in the Strait of Hormuz, a key route for oil tankers, mind you. And all this creates a perfect storm for risky assets. So investors are moving into defensive instruments now. And now there's a news that makes you forget all the negativity in long-term future. On May 14th, the U.S. Senate Banking Committee approved the Clarity Act bill. The vote was 15-9, and even some Democrats, like Senator Ruben Gallego and Angela Olsbrooks, joined the bipartisan support. And this, my friends, is a historical moment. What does this bill do for us? It formally delimits the powers of the SEC and the CFTC, determines which digital assets are securities and which are commodities, regulates stablecoins, provides bankruptcy protection for clients of crypto exchanges, and sets the rules for DeFi. Analysts call it the most comprehensive cryptocurrency legislation in American history. And what does this mean in practice? Banks will finally be able to safely store and service cryptocurrencies without fear of being sanctioned by the regulators. The institutional money that has been waiting on the sidelines is finally getting the green light, and investors are getting the long-awaited clarity. Also, Coinbase CEO Brian Armstrong called it a historic day for cryptocurrencies and for the future of digital assets in America. So what's going to happen next? The bill is being sent for full vote in the Senate. If it passes, it will be considered by the House of Representatives, and the optimistic scenario is that the president will sign it by July 4th. And bipartisan support is also expected to remain. Both Trump and Biden have already spoken out in favor of regulating the crypto industry. After the news of the approval, the market reacted instantly. The price of Bitcoin jumped to almost $82,000. Coinbase grew by 9.1%, MicroStrategy by 8.16%, Robinhood by 6.16%. And in a few hours, more than $250 million on short positions were liquidated. XRP reacted explosively. The asset grew by more than 6% because the Clarity Act directly resolves the issue of its status. And as you can see, euphoria was short-lived because macroeconomics just destroyed everything. So here we come to the key contradiction of the week. On one hand, institutional investors seems to be coming in. From May 4th to May 8th, crypto funds raised $858 million, Bitcoin products $706 million, and the shorts were withdrawing $14 million on the buyers or losing ground. The senatorial vote on the Clarity Act, as we have just said, caused a short-term stir. But on the other hand, the data from the current week paints a completely different picture. According to Farsight, in the week to May 16th, spot Bitcoin ETFs lost more than $1 billion. And this is the strongest weekly outflow since January. The largest one-day outflow occurred on May 13th, $630.4 million. BlackRock and Fidelity funds became the leaders of the outflow, and this is literally the day after the release of inflation. And what does it mean? It means that institutional investors who entered Bitcoin at the beginning of the year began to take profits en masses. Analysts call this normal behavior in a growing market, but the very fact that $1 billion went away in just 1 week suggests that major players are not confident of continuing growth in the short term. But interestingly enough, XRP and Solana are breaking out of this trend. XRP ETFs raised $18.5 million on the day of the Clarity Act vote. Solana funds show inflows of 11 consecutive days. Investors expect the effect of the Alpengolo update, but the overall market picture is just obviously alarming. Despite the price drop, there are also positive signals at the blockchain level. The ASOPR indicator held above level 1 for 9 consecutive days last week. And what does it mean? It means investors sell coins at a profit, not a loss, and the market successfully absorbs the supply. And the structure of this indicator resembles October/November of 2023, with the the period when Bitcoin was preparing for the start of a big rally. But of course, there are also disturbing metrics. Perpetual futures financing rates remain negative the most part of the week, and this means that bears dominate the derivatives market. And there is no demand for long leverage. Open interest continues to grow even though the price is falling, and an increase in open interest with a falling price is a classic sign of accumulation of short positions. Traders are betting on future fall. On one hand, this is bad, but on the other hand, it creates conditions for a powerful short squeeze if the market suddenly turns around. An analyst under the nickname Dan Creep the Trades believes that the next major liquidity zone below current prices is $71,000 level, and this is where the cushion of stop losses and limit orders is located in his opinion. The MVRV indicator also raises questions. Analysts note that current cycle is unique due to influx of institutional capital, as you remember, and the old patterns no longer work, and investors should not wait for classic bottom signals because they may just not come ever. So while Bitcoin is in a fever, altcoins are slowly starting to wake up. XRP became the hero of this week because the asset broke through a multi-week resistance, and growth accelerated after the news about the approval of the Clarity Act. Traders attribute this to the fact that the bill will definitely clarify the status of XRP. Solana is also in focus. Funds show inflows of 11 consecutive days, and the reason is the Alpenglow update, which has already been launched on the testnet and promises a significant increase in transaction speed. BNB surprised me. At the height of the week, the asset rose 2.5% to $677, becoming the leader of the day. Dogecoin also gained 1.3%, but Ethereum, on the contrary, feels worse than the rest because it has dropped 3.2% in just 7 days. Analysts attribute this to the lack of spot demand. Unlike Bitcoin, Ethereum has no inflows from ETFs and no positive news, unfortunately. Nevertheless, Van de Pope and other analysts believe that altcoins have huge growth potential. Many of them have fallen by 80 to 90% from their 2024 peaks and are just starting to recover. Now let's talk about the forecasts, and opinions of experts are divided because we have several camps. First one, bearish camp. Analysts indicate that Bitcoin has broken through the ascending triangle downwards, and the next targets are $75,000 and $71,000 until the price closes the weekly candle above $81,800. It's too early to talk about a bullish trend. The real purchase price of short-term holders is exactly there, and the distortion of the data should not be misleading for anybody. Next one is bullish camp. Michael Van de Pope believes that the market is emerging from the bearish phase, and he recalls that before halving, many did not believe in the renewal of the heights. No one noticed the rebound from 60 to 70, and the market is changing its mode, but most people just don't see it. And the last camp, a realistic camp. Analysts from KuCoin and a chain catcher pay attention to the paradox. It's difficult for Bitcoin in a short term due to inflation and high interest rates, but a medium-term mass withdrawal from funds could channel liquidity into cryptocurrencies, and Japanese and European investors are looking for alternatives. Don't forget about it. Listen, I do not give investment recommendations, but I will tell you what I'm doing myself. I am not touching the spot portfolio just yet. If there is a drop, I will buy at a level of 75 to 70. And I'm also not closing my long with 3x leverage because I believe that the price will definitely not go below 60K, But I don't see any point in opening a new long with high leverage until we break through the $80,000 mark. But after breaking through it, I think we can get along with like 5 to 7x leverage. And by the way, if you want to buy and trade cryptocurrencies, I would like to remind you again about the sponsor of my channel, which I used for a long time before creating the channel itself. OKX Exchange is the best and most transparent solution for traders today, and if you want to join and get welcome bonuses while supporting my channel as well, see the link in the description box down below. All right, what is in the store for the market this week? In short term, the pressure remains, inflation is not receding, bond yields continue to rise. If Bitcoin does not stay above 78,000, the next stop is 75 and then 71 or $72,000. At the same time, the market has accumulated a lot of short positions, and any positive catalyst, even rumors of a truce in the Middle East or positive comments from the Fed, can trigger a powerful short squeeze. In the medium term, Clarity Act remains the main hope of the market. If the bill passes a full vote in the Senate, we may see a new influx in institutional capital and banks will finally get regulatory certainty. Analysts expect a full vote to take place in the coming weeks, and if everything goes according to plan, the signing by the president is possible by July 4th. As for the Fed, the next meeting is on June 17th and 18th. The market assumes 100% probability of maintaining the rate, and it's just a matter of rhetorics. If they hint at possibility of easing in the second half of the year, Bitcoin may respond with growth. But if they say that inflation has not yet been defeated, we need to expect a new wave of decline. And that's going to be it for today. Link to OKX is in the description. Subscribe, click on that notification bell, and I will see you tomorrow. Bye.